Most traders believe they're reading market patterns when they study breakouts and support levels, yet the chart reveals a harsher truth. Technically perfect setups fail while ugly. Contradictory entries run far beyond rational expectations. That jarring disconnect exposes the fundamental deception underlying retail analysis. What appears as random price movement is actually the carefully orchestrated campaign work of what Richard Wyckoff called the composite man. This isn't market mysticism or conspiracy theory. It is the mechanical reality of how institutional money must operate to accumulate massive positions without driving prices against themselves. When your textbook bullish flag breaks down immediately after a picture-perfect breakout, while a messy, conflicted setup suddenly explodes upward with sustained momentum, you are witnessing the difference between composite man presence and absence. Wyckoff understood this distinction because of his extraordinary position in financial history. As both a successful trader and founder of the Magazine of Wall Street, he gained unprecedented access to the legendary operators of his era, Jesse Livermore, J.P. Morgan, James Keane, who didn't hide their methods but explained them. Knowing that understanding principles and applying them under emotional pressure were entirely different challenges. Through decades of direct observation and instruction from these titans, Wyckoff decoded the systematic approach they used to move millions of shares without detection. He discovered that apparent market chaos was actually planned campaigns, each following predictable phases designed to achieve specific institutional objectives. The composite man represents the collective force of institutional money, pension funds, insurance companies, mutual funds, hedge funds, and banking operations that must accumulate or distribute positions measured in millions of shares over weeks or months. These entities cannot simply place market orders for their desired quantities, because such actions would immediately drive prices against them, making accumulation prohibitively expensive or distribution unprofitably cheap. Instead, they must work systematically, using time, patience, and sophisticated crowd psychology to achieve their objectives while disguising their activities. This creates a fascinating paradox. The very institutions driving major price movements must hide their presence to be effective, yet their disguise follows recognizable patterns for trained observers. The composite man's campaigns leave fingerprints in volume signatures, price spreads, and reaction characteristics that cannot be completely concealed from systematic analysis. Wyckoff identified 5 fundamental laws governing these operations, laws that remain as relevant today as a century ago because they're based on immutable principles of human nature and market mechanics rather than temporary technical patterns. The first law explains the mechanical force behind every significant movement. The second provides the mathematical relationship between preparation time and resulting magnitude. The third offers real-time confirmation of institutional participation. The fourth reveals predictable phases through which every campaign must progress. The fifth addresses the psychological discipline required to align with rather than oppose institutional operations. For traders who suspected hidden forces at work, Wyckoff's framework provides profound validation. Your intuition was correct, but incomplete. Understanding these laws transforms trading from reactive pattern recognition to proactive institutional intelligence gathering. Instead of hoping your technical analysis coincides with institutional intentions, you learn to read those intentions directly from price and volume action. Instead of fighting mysterious reversals and false breakouts, you recognize them as natural elements of systematic campaign work. Instead of feeling victimized by manipulation, you develop the ability to identify when it is occurring and position accordingly. The promise is significant but demands abandoning comfortable illusions about market randomness. Success requires understanding the composite man's methodology rather than opposing it. When you accept that apparent indecision is actually negotiation, that news serves as camouflage rather than catalyst, and that the best opportunities exist where the market must declare its institutional intentions, trading becomes the disciplined art of alignment, with dominant forces rather than futile resistance against them. If this reframing resonates, comment one word: clarity, because the journey from confusion to mastery begins with accepting that the market you thought you knew simply doesn't exist in the way you were taught to perceive it. Having established that the composite man orchestrates what appears as random market movement, we encounter Wyckoff's first and most fundamental principle, the law of supply and demand. This law states that price advances only when demand exceeds supply. declines only when supply overwhelms demand and moves sideways when these forces achieve temporary equilibrium. While this appears elementary, the profound insight lies in recognizing that these imbalances are not natural market occurrences but deliberately manufactured conditions created through systematic institutional campaign work. The composite man cannot simply place massive buy or sell orders without immediately driving prices against their objectives, making accumulation prohibitively expensive or distribution unprofitably cheap. Instead, they must engineer the very supply and demand imbalances they need to execute their large-scale position changes, transforming what appears as market indecision into sophisticated inventory management operations. During accumulation campaigns, institutional money faces a fundamental challenge, acquiring millions of shares without creating obvious demand that would attract competing buyers or drive prices higher prematurely. They solve this through strategic absorption, patiently encouraging weak holders to sell by creating an environment of persistent price weakness and bearish sentiment. This process unfolds through preliminary support that establishes a lower boundary, selling climaxes that exhaust panic selling, automatic rallies that test for remaining supply, and secondary tests that confirm absorption completion. Throughout these phases, the composite man resists natural buying impulses, instead allowing natural selling pressure to come to them through patient bidding below market prices. The psychological manipulation operates through sustained discouragement, failed rallies, broken support levels, negative news flow that gradually erodes retail conviction and transforms hopeful holders into willing sellers. What appears as technical weakness is actually evidence of systematic accumulation, with volume expanding on declines as institutions absorb selling pressure, while contracting on rallies as they avoid competing with public buying. The distribution process reverses this methodology with equal sophistication. When institutions need to liquidate substantial positions, they cannot flood the market with selling without immediately depressing prices and reducing their average exit price. Instead, they must create demand from uninformed buyers by fostering optimistic sentiment and participating in upward price movements while gradually distributing their holdings into the enthusiasm they help generate. This unfolds through preliminary supply that reveals difficulty advancing, buying climaxes that attract late participants, automatic reactions that break complacency, and upthrusts through resistance that trap momentum buyers. The composite man strategically sells into strength, often initiating smaller buying programs to maintain upward momentum while systematically unloading their core position. The psychological trigger operates through greed and fear of missing out, positive news flow, analyst upgrades, technical breakouts that compel retail participation precisely when institutional money seeks liquidity for their selling programs. Volume signatures during distribution show expansion on strength as institutions participate in upward movements to facilitate selling, while contracting on weakness as they avoid adding to downward pressure that would interfere with their objectives. This creates the cruel irony that retail traders' natural inclinations, buying strength and selling weakness, provide perfect counterparty liquidity for institutional campaigns. During accumulation, retail fear and technical breakdown selling supply the shares institutions need. During distribution, retail greed and breakout buying provide the demand institutions require. Wyckoff observed this principle operating across all timeframes and market conditions because it reflects the immutable requirements of large-scale money management. A pension fund cannot accumulate 10 million shares through conventional methods without dramatic price impact, necessitating systematic campaign work over weeks or months using every available technique to disguise their activities while achieving position objectives. The volume signature becomes crucial for real-time identification of these manufactured imbalances. Genuine accumulation shows expanding volume on weakness as institutions absorb selling pressure, with contracting volume on rallies as they avoid competing with public buying. Genuine distribution reveals expanding volume on strength as institutions facilitate their selling through participation in upward movements, with contracting volume on declines as they avoid interfering with their distribution process. These patterns provide essential confirmation that apparent price weakness or strength reflects institutional positioning rather than random market fluctuation. Understanding this first law transforms perspective from reactive pattern recognition to proactive institutional intelligence gathering. Instead of fearing breakdowns during accumulation, trained observers recognize them as natural absorption elements. Instead of celebrating breakouts during distribution, They understand these as potentially manufactured demand designed to facilitate institutional selling. The law provides logical framework for interpreting price action as purposeful campaign work rather than random noise. Yet while supply and demand determines direction, understanding the time and intensity required to create these deliberate imbalances demands examining the mathematical relationship between preparation and result. Understanding that the composite man creates supply and demand imbalances through systematic campaign work leads directly to Wyckoff's second fundamental principle, the law of cause and effect. This law establishes the mathematical relationship between horizontal trading ranges, where accumulation or distribution occurs, and the subsequent vertical price movements that result from these preparatory phases. Wyckoff observed that the duration, volatility, and volume characteristics of sideways price action directly correlate to the magnitude and sustainability of the markup or markdown phases that follow. This isn't mystical market theory but mechanical necessity. Even the composite man cannot violate the physical requirements of large-scale position changes, making cause and effect a reliable constant for systematic analysis rather than hopeful speculation. The cause represents the accumulation or distribution campaign itself, measured through both time and intensity within horizontal trading ranges. A brief consolidation with light volume and narrow ranges can only support limited price movement because insufficient cause has been built to sustain extended markup or markdown phases. Conversely, extended horizontal action with heavy volume and wide intraday ranges creates substantial cause capable of supporting significant vertical movements. Consider an accumulation where price oscillates between $48 and $56 for 8 weeks, with volume contracting on rallies and expanding on declines. Using point and figure counting methodology, this range might generate a 40-box horizontal count on a $1 scale, suggesting approximately 40 points of potential upward effect from the breakout level. The effect represents the resulting price movement that naturally follows completed cause, building phases. Just as a compressed spring must release energy proportional to the force applied during compression, completed accumulation phases must produce upward movements proportional to the institutional buying pressure absorbed during the horizontal campaign. Similarly, completed distribution phases generate downward movements reflecting the institutional selling pressure distributed during the preparatory phase. The composite man cannot manufacture effects without first building adequate cause, creating predictable relationships between preparation time and resulting magnitude that trained observers can measure and anticipate. Quality matters as much as quantity in cause building assessment. A wide count created by violent, news-driven spikes may not support a proportional move if the character of the range shows persistent supply on rallies, whereas a narrower but orderly base with successful tests can generate surprisingly durable effects. The volume signature during cause building phases provides essential intelligence about institutional participation intensity. Heavy volume during horizontal action indicates active institutional campaign work, with the composite man either absorbing selling pressure during accumulation or facilitating distribution through participation in both directions. Light volume during sideways movement suggests minimal institutional interest, limiting the potential magnitude of subsequent effects regardless of time duration. This mathematical relationship operates independently of news events, earnings announcements, or external catalysts because it reflects the mechanical requirements of institutional position changes rather than reactive market sentiment. When substantial cause has been built through extended accumulation, the resulting markup phase will unfold regardless of temporary negative news because the underlying supply-demand imbalance has been systematically engineered. Conversely, when insufficient cause exists, despite positive developments, any resulting price advance will be limited and unsustainable because the necessary institutional foundation hasn't been established. The psychological transformation from understanding cause and effect proves profound for trading discipline. Instead of hoping for large moves from brief consolidations or fearing extended sideways action as wasted time, trained observers recognize horizontal ranges as manufacturing floors where institutional inventory is built or unloaded. This patience-based approach directly opposes retail tendencies toward immediate gratification, which typically leads to entering positions during early accumulation phases and exiting during temporary setbacks before adequate cause has been established. Such impatience provides perfect counterparty liquidity for institutional campaigns while preventing retail participation in the substantial effects that follow completed cause-building phases. Wyckoff's background as both successful trader and financial journalist provided unique verification opportunities for these cause-effect relationships across thousands of individual campaigns spanning multiple market cycles. He observed that even the most sophisticated institutional operators could not circumvent this fundamental law because it reflects the physical limitations of moving large quantities of shares without market disruption. The mathematical precision of these relationships transforms trading from emotional gambling based on hope and fear into systematic analysis grounded in measurable institutional activity. The practical application requires defining danger points near breakout levels or recent test lows, setting position size so that failure back into the range risks little compared to projected objectives, and adding only as cause converts to effect. When projected effects are not met despite apparently sufficient cause, the tape is speaking, suggesting either hidden opposition inside the range, misdiagnosed intent, or market-wide context changes that invalidate campaign progression. This demands defensive posture rather than argumentative averaging, because the law provides framework for analysis, not guaranteed predictions. While cause and effect establishes the mathematical relationship between preparation and outcome, determining whether sufficient cause has been built requires real-time confirmation through analyzing the divergences between institutional effort and resulting price movement. Having established the mathematical relationship between cause-building phases and their resulting effects, we encounter Wyckoff's most practical law for daily trading decisions, the law of effort versus result, where volume represents effort and price movement with closing location represents result. This principle transforms abstract institutional analysis into real-time intelligence by examining whether the energy expended in trading activity produces proportional price movement in the expected direction. When effort and result align harmoniously, the movement reflects genuine institutional participation and possesses sustainability. When effort and result diverge significantly, the movement lacks institutional foundation and warns of potential reversal or stagnation. This law serves as the composite man's lie detector because while price patterns can be manipulated through relatively small transactions, volume patterns reveal true institutional scale and cannot be easily disguised by surface-level operations. During genuine markup phases following completed accumulation, effort and result demonstrate natural harmony as institutional money supports advancing prices with sustained participation. Widespread advances occur on expanding volume with closes near the highs, indicating that demand is overcoming supply with institutional sponsorship. Pullbacks show narrow spreads on contracting volume with closes away from the lows, confirming absence of selling pressure and validating that previous accumulation successfully absorbed available supply. This effort-result alignment creates the ease of movement that characterizes authentic institutional campaigns, where price advances encounter minimal resistance because opposing supply has been systematically eliminated during the preparatory phase. The volume signature reveals institutional confidence through consistent participation in directional movement, while avoiding actions that would interfere with campaign objectives. Conversely, when markup attempts occur without adequate cause, building, effort, and result relationships immediately expose the deception. Heavy volume producing narrow spreads, or wide spreads that close poorly indicate significant resistance to upward movement, suggesting either incomplete accumulation or active distribution by other institutional participants. When supposed strength shows enormous effort but minimal result, the tape reveals hidden supply absorption that contradicts the bullish narrative. These divergences warn trained observers that apparent strength masks underlying weakness, providing early warning signals before technical breakdowns become obvious to conventional analysis. The composite man cannot disguise their true intentions when volume requirements for genuine campaign work exceed their available resources or conflict with their actual objectives. Climactic action provides the most dramatic examples of effort-result analysis in practice. A selling climax during accumulation often shows enormous downside volume with relatively narrow spreads and closes off the lows, indicating that massive selling pressure is being absorbed by institutional buying rather than driving prices dramatically lower. This represents maximum effort producing minimal result in the direction of the effort. suggesting successful accumulation completion rather than bearish breakdown. Similarly, buying climaxes during distribution reveal heavy upside volume with limited price progress and poor closing action, suggesting institutional selling pressure that absorbs enthusiastic public buying without allowing proportional price advancement. The subsequent automatic reactions provide confirmation. Genuine climaxes are followed by sustained movement in the opposite direction as the absorbed pressure is released. Springs and up thrusts represent extreme expressions of effort, result discord at trading range boundaries. A spring shows apparent breakdown effort that fails to produce sustainable result, often followed by immediate recovery back into the range as the breakout attempt reveals no genuine supply below the support level. An upthrust demonstrates apparent breakout effort that cannot maintain result, typically followed by quick rejection back into the range as the advance encounters prepared supply above resistance. These false movements become readable through effort result analysis. The initial breakout bar may show respectable effort, but the subsequent inability to follow through or immediate reversal exposes the trap because institutional opposition was waiting in force. The practical application requires systematic measurement rather than impressionistic analysis. Compare current volume with the average of recent sessions to assess effort intensity. Evaluate spread width relative to recent true range to measure result magnitude. Examine closing location within the bar to determine who controlled the final negotiation. During trending phases, healthy bullish action shows expanding spreads on increasing volume during advances with contracting spreads on decreasing volume during pullbacks. Healthy bearish action demonstrates expanding spreads on increasing volume during declines with narrow spreads on light volume during rallies. When these relationships invert light volume advances or heavy volume pullbacks in uptrends, the effort result discord warns of potential trend exhaustion or reversal. The psychological challenge lies in trusting mechanical tape reading over emotional market narratives. When positive news drives apparent breakouts but volume analysis reveals inadequate effort supporting the result, the law suggests institutional resistance rather than confirmation. When negative developments create apparent breakdowns but effort result relationships show strong downside effort producing minimal result, the analysis indicates absorption rather than distribution. This requires abandoning hope-based and fear-based decision-making in favor of disciplined observation that prioritizes institutional evidence over emotional interpretation. The integration of effort-result analysis with previous laws creates comprehensive institutional intelligence where supply-demand imbalances become visible through volume signatures, cause-effect relationships gain real-time confirmation, and the systematic phases of institutional campaigns reveal themselves through characteristic patterns that expose rather than conceal composite man intentions. The mechanical precision of effort-result analysis reveals why the composite man cannot operate through random impulses, but must follow Wyckoff's fourth fundamental principle, the law of systematic campaign phases. This law formalizes how institutional money progresses through four predictable sequences: accumulation, markup, distribution, and markdown, each representing mechanical necessities for large-scale position changes rather than arbitrary patterns. Even the most sophisticated institutional operators cannot circumvent these phases because they reflect the physical limitations of moving substantial quantities without market disruption. Understanding these systematic phases transforms apparently chaotic price action into recognizable institutional blueprints that expose composite man intentions through characteristic events, volume signatures, and tactical manipulations designed to achieve specific campaign objectives while disguising their activities from competing participants. The accumulation phase begins with preliminary support, where institutional buying interest emerges to establish a lower boundary, followed by selling climaxes that exhaust panic selling through maximum downside effort, producing minimal result as professionals absorb the pressure. Automatic rallies test for remaining supply by allowing natural buying to develop, revealing through effort-result relationships whether sufficient selling pressure has been eliminated. Secondary tests return to or near the selling climax lows to confirm that supply has been successfully absorbed, typically showing reduced volume and improved price action as evidence of completed accumulation. The spring represents the final manipulation where apparent breakdown below support shakes out remaining weak holders while immediately revealing no genuine supply exists. followed by swift recovery back into the range as institutions complete their absorption campaign. Throughout accumulation, volume expands on weakness as institutions provide bid support that absorbs selling pressure, while contracting on strength as they avoid competing with natural buying that would drive prices higher prematurely. The psychological manipulation operates through sustained discouragement, failed rallies, broken support levels, negative sentiment, that gradually transforms hopeful holders into willing sellers who provide the inventory institutions require. The markup phase demonstrates ease of movement that characterizes authentic institutional campaigns where previous accumulation successfully eliminated opposing supply. Sign of strength appears as the first decisive advance above the accumulation range on expanding volume with wide spreads and strong closes, indicating institutional participation in directional movement. Last point of support provides the final opportunity to join the campaign at favorable risk-reward ratios, typically showing narrow spreads on light volume as institutions avoid interfering with natural pullbacks that bring in additional participants. The sustained advance unfolds with expanding volume on advances and contracting volume on pullbacks, creating natural rhythm where effort and result align harmoniously throughout the directional phase. Back up to the edge of creek offers the metaphorical last low, risk entry as price returns to breakout levels but holds with improved action, confirming that resistance has transformed into support through successful institutional sponsorship. Distribution phases mirror accumulation with opposite objectives, as institutions transfer accumulated positions to uninformed buyers attracted by apparent strength. Preliminary supply emerges as the first evidence of difficulty advancing, showing increased effort producing diminished result, as selling pressure begins emerging at higher levels. Buying climaxes attract late participants through apparent breakouts above resistance, but heavy volume with poor closing action reveals institutional selling into the enthusiasm they help generate. Automatic reactions break complacency established during markup, testing whether sufficient demand exists to absorb institutional selling pressure. Secondary tests return toward buying climax highs, but typically fail to exceed them on reduced volume and weaker action, confirming that distribution progresses successfully. Up thrusts represent final manipulation where apparent strength above resistance traps momentum buyers, while revealing that institutional selling has absorbed all available demand, immediately followed by weakness back into the range as campaigns transition toward markdown. The psychological trigger operates through greed and fear of missing out. Positive news flow, analyst upgrades, technical breakouts that compel retail participation precisely when institutional money seeks liquidity for selling programs. Markdown phases reflect natural consequences when institutional support is withdrawn and selling pressure encounters minimal buying interest. Sign of weakness appears as the first decisive decline below distribution ranges on expanding volume, indicating institutional selling has overwhelmed available demand. Last point of supply provides rallies that fail to regain distribution ranges, typically showing heavy volume with poor results, as remaining institutional selling absorbs any buying interest. The sustained decline unfolds with expanding volume on weakness and contracting volume on rallies, creating natural rhythm of institutional absence where selling pressure encounters insufficient buying support. These systematic phases integrate all previous laws into comprehensive institutional intelligence. Supply-demand provides direction. Cause, effect quantifies magnitude, effort, result confirms authenticity, and systematic phases provide strategic context for positioning. The psychological challenge lies in recognizing that horizontal phases represent the most important institutional activity rather than boring inaction, requiring patience that directly opposes retail tendencies toward immediate gratification. Yet while understanding systematic phases provides strategic framework, successful application demands overcoming the emotional and psychological traps that sabotage disciplined analysis when fear and greed overwhelm systematic observation. Mastery of supply, demand imbalances, cause-effect relationships, effort, result analysis, and systematic campaign phases creates formidable analytical power. Yet Wyckoff's fifth and final principle determines whether this knowledge transforms into consistent profits or remains academic theory, the law of emotional discipline. This law confronts the harsh reality that understanding institutional mechanics intellectually and executing them consistently, while money is at risk, represent entirely different challenges. with emotional interference sabotaging even sophisticated analysis when fear, hope, greed, and ego override systematic observation. The composite man's greatest weapon is not price manipulation but psychological manipulation, harvesting liquidity from predictable human reactions that occur precisely when disciplined analysis would suggest opposite actions. Markets reward alignment with institutional forces, yet our natural emotional responses create systematic opposition to these very forces, transforming potential allies into adversaries through undisciplined execution. Hope represents the most destructive emotion because it demands large effects from insufficient cause, compelling traders to enter positions during early accumulation phases, when ranges appear boring, and exit during springs or secondary tests, precisely when institutional absorption nears completion. The hopper archetype chases breakouts without measuring cause, building through point and figure counts, expecting immediate gratification from brief consolidations that cannot support sustained movement. They abandon positions during the most crucial campaign elements, the final manipulations that shake out weak holders before markup begins, providing perfect counterparty liquidity for composite man operations while missing the substantial effects that follow patient preparation. Hope also manifests through averaging down during distribution phases, refusing to acknowledge that apparent strength masks systematic institutional selling designed to transfer positions at favorable prices. Fear operates as hope's counterpart, creating paralysis during optimal entry opportunities and panic exits during natural campaign elements that represent institutional positioning rather than genuine threats. The fader archetype fights institutional ease of movement by selling strength during markup phases and buying weakness during markdown phases, consistently positioning against rather than with dominant forces. They interpret springs as genuine breakdowns requiring immediate exit, rather than recognizing them as final absorption tests, while viewing last points of support as dangerous weakness instead of final low-risk opportunities. Fear prevents participation during sign of strength breakouts because previous false starts created emotional scarring that overrides volume evidence and effort result confirmation. Greed manifests through position sizing that exceeds systematic risk management, transforming calculated analysis into emotional gambling where single trades threaten account survival. The anchored archetype becomes married to positions despite new evidence contradicting original analysis, refusing to acknowledge when effort-result relationships indicate institutional opposition has emerged. They hold through up thrusts and preliminary supply signals because profitable positions create emotional attachment that overrides disciplined exit criteria established during initial analysis. Greed compels adding to positions against volume evidence, pyramid buying during late markup phases when distribution may be beginning, or refusing partial profits when projected effect objectives are achieved. Ego represents perhaps the most subtle destroyer because it demands being right rather than profitable, creating argumentative relationships with market action that prevent adaptive responses to changing institutional conditions. The storyteller archetype prefers fundamental narratives over tape reading, constructing elaborate justifications for why their analysis must eventually be vindicated regardless of contrary volume signatures or phase transitions. They fight the tape through intellectual stubbornness, averaging into positions showing persistent institutional opposition while dismissing mechanical evidence as temporary noise that will resolve in their favor. Ego prevents acknowledgement of analysis errors, creating defensive rather than learning mindset that compounds mistakes through stubborn position maintenance. The integration of all 5 laws requires systematic discipline that prioritizes mechanical observation over emotional impulses. Supply-demand analysis must override hope by accepting that accumulation requires time and patience rather than immediate gratification. Cause-effect measurement must override greed by establishing realistic objectives based on actual preparation rather than wishful thinking. Result analysis must override fear by trusting volume evidence over emotional interpretation of price patterns. Systematic phases must override ego by accepting campaign transitions rather than arguing with institutional intentions. This creates an operating framework where emotional impulses are acknowledged but not allowed to interfere with systematic positioning aligned with dominant institutional forces. The practical application demands developing emotional discipline through mechanical execution protocols, position sizing based on distance to danger points rather than conviction levels, predefined exit criteria established during calm analysis rather than heat of battle decisions, systematic review processes that separate what was observed from what was imagined, converting vague impressions into falsifiable analysis that can be audited and improved. The ultimate insight reveals that successful application of Wyckoff's laws requires not overcoming emotions but channeling them productively through systematic framework that transforms fear into appropriate caution, hope into patient observation, greed into calculated risk-taking, and ego into disciplined analysis. When these 5 laws operate together through emotional discipline, trading becomes institutional intelligence gathering rather than emotional gambling, where composite man intentions become readable through mechanical analysis that exposes the systematic manipulation driving all significant market movements.